Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for November 16th, 2020. Please see our disclaimer for important information. So in our conversation this week, we continue to see some positive activity out of the equity markets, some positive activity out of bond yields, and we get a little bit further removed from the election, and we continue to see positive developments on the vaccine front, all of which are kind of playing into sentiment right now. But last week, the Dow was up 4.1%, the S&P 500 was up 2.2%. NASDAQ was off slightly as we saw a little bit of rotation into more of the industrial cyclical stocks as opposed to the technology stocks. A bit of a rotation there. Value, again, performing a little bit better than we've seen it lately. Russell 2000 was up 5.4%, so we've seen a little bit of better activity out of small caps, and this is the first time since 2000 that the Dow was up over 4 and the NASDAQ was actually negative. So S&P 500 did hit an all-time high and was up the month to date about 9.6% for the month of November here, and up almost 11% year to date, despite the pandemic related shock that we had earlier this year. Interestingly enough, and I think we showed this in our charts of the week, the strength is becoming more broadly based. Whereas earlier this year we had a really high concentration of performance coming out of the super large stocks in the S&P 500 index, but 81% of the stocks are now above their 200-day moving average. So we're seeing a broader based movement in stocks right now, which I think is very healthy. NASDAQ has seen its third weekly loss in the last 4 weeks. And the Russell 2000, conversely, has had its first record close since at least a couple of years. So, and we continue to see a large influx. And last week was like $44.5 billion moving into equity funds, kind of on the tailwinds of this Pfizer announcement. And then here this week we've got Moderna also jumping into the fray with a very preliminary positive vaccine trial. So if you look at year to date, obviously we've got a little bit of disconnect between the S&P and the Dow Jones. S&P, as I mentioned, is up 11%. Dow Jones is up 3.3%, and NASDAQ, the technology stocks, are still up almost 32%. Europe still remains a bit challenged. Obviously, we've got a second wave in Europe to correspond with the large spike in coronavirus cases we're experiencing in our country. But the European markets have had a really good month, but they're still down for the year. So like Europe is down 3.65, even though it was up about 14% for the month here to date. EFA, which is kind of a more broadly based Europe, African, and Far East, is up 12.2 for the month, but still down about 2% for the year. And emerging markets have actually done pretty well, up about 7.6%, 7.7 for the month, and about 6.6 for the year. So, and we continue on the bond market to look at, high yield, which is up about 3.8% year to date. Had a reasonable month, up 2.6. Even real estate, the MLP, which is in the energy sector, where they had strong months. The Dow Jones U.S. Real Estate Index was up about 11%. It is up 11% month to date. MLPs, multiple limited partnerships, are up 14.2. Those are like pipelines and more of the downstream annuitized type investments that you can make within the energy sector. Hedge funds doing their job, up slightly year to date, and as for the month. The gold, on the other hand, kind of holding its own, again, still in a trading pattern that's slightly below $1,900 an ounce, up about 24% for the year. And the 10-year Treasury had been in a very tight band from call it like 55 to 75 basis points is kind of punched through, and it seems to be holding now around 90 basis points or 0.9%. And so for the quarter, it's up about 20 basis points, even though versus a year ago, we're down a little bit more than a full percentage point. But so, I mean, obviously the global markets reacted last week positively to news around the pandemic. We had the Pfizer news of the vaccine trial. And then, towards the end of last month, we had a little bit of maybe a erosion, based on the case volume that we know that even though there's vaccines that are likely on the horizon next year, that we're going to have to put up with a kind of a challenging holiday season. And we know that, there are a lot of shutdowns and things like that. And, even my daughter in New York City is said that they're talking up there about imposing lockdowns and things like that. And, obviously that's going to have an impact on economic activity that's hard to gauge right now. But, earnings reports, so we've seen third quarter earnings are pretty much mostly in the bag here. And so we were down, earnings were down 9% year over year. And that was much, much better than what we thought going into this. I mean, that was looking like -17, -20, somewhere in that area. We saw widening profit margins, which in some cases are back to pre-COVID levels, which is really phenomenal. A lot of companies are cutting costs. But the long term, there's a lot of long term optimism that's building. There are puts and takes. I'll talk about the Fed stability, financial stability report, which it throws a little bit of cold water near term on what we can expect. But I think the long term horizon is still fairly strong. Obviously we had near term virus cases, crude oil. We had crude oil is trading around $40 a barrel. Even though stocks are not performing, we're beginning to see perhaps what might be a bottom in terms of rig counts and things like that. Sentiment indicators, the National Federation of Small Business. We have two charts in our Charts of the Week pack that show you this, that it's very interesting that small business optimism index or indices remain elevated and have re-attained pre-COVID levels. But we know that there's a lot of small businesses hurting right now. And interestingly enough, amidst that, we've had a slide in consumer sentiment, which was the November number was significantly below expectations. So, the consumer represents this, 66, 2/3 of the economy, call it. And we really need the consumer to perform. Again, there are Charts of the Week, charts that kind of talk about this uncertainty over holiday spending, which we're going to have to monitor. But we know that sentiment indices are sliding a little bit. Some of that has to do with the coronavirus caseload and some of the news flow related to that. But small business optimism, I think it's really good to see that, even though there's a lot of small business that continues to hurt. So I just thought that those were two interesting takeaways. As I mentioned, corporate profits are really, really doing well. Stock that's had a lot of the, and that has a lot to do with the reason why stocks have had a pretty decent recovery. And U.S. GDP now has recovered about 2/3 of its virus-induced drop. And we've talked about the market overall trading about, just under 22 times next year's earnings, whereas the 5-year average is about 17.5, and the long-term average is about 16. So we are much higher than the trend line would suggest. But if you take out the large tech stocks, which are trading close to 30 times earnings, the valuation that we see in the market is really not that bad. So I just want to caution that. But risks on the margin, market may need some time to digest these gains. And then obviously I mentioned the partial shutdowns and the fiscal relief packages, are a little bit uncertain right now. I think we're getting more and more clarity every day with regard to what's going to happen, the final tally of all of this election stuff. And I think fiscal likely is probably less likely during this lame duck session. Um, and and then obviously we've got, some tops. It looks like some of these FANG stocks might be a little toppy, and they're beginning to show, as I mentioned, less leadership, but also more volatility. And so their influence on the index, I think, is something we're going to have to monitor, because it could promote, even with the other 490 plus stocks in the index, perhaps performing better, the top 10, because of their outsized nature and the fact that the S&P 500 is a market capitalization weighted index. So these large tech stocks could have an outsized influence on things here. So the San Francisco Fed did a little study on valuations, and the cyclically adjusted PE ratio is currently at 31, over 31 times, and this is like a 10-year moving average, if you will. And so it's higher than over 95% of the readings that we've seen, well over a century. So I think, near term, I think, and over the intermediate term, I think if this recovery takes root with with vaccines, we have some staying power. But if you look over a long period of time, let's call it 10 years, that this model, this CAPE ratio, it tends to predict that the dividend adjusted S&P 500 returns will be much more muted. And so, I just throw caution into the wind just to say, like, at the near and the intermediate term, I think look okay. Longer term, we'll have to maybe take into consideration perhaps a little bit lower estimated returns for asset classes in our financial planning work. So just looking at things on the margin, let's talk about the financial stability report from the Federal Reserve. The top risks in their assessment remains the pandemic. And there's risk factors. If it lasts longer than expected, it could obviously derail things that are going on with recovery and put some strain on the financial markets. And we may still have a wave of debt defaults and potential risk to asset prices. And then we do know that business debt has really taken off this year, even though default rates are not onerous. And we know that revenues are a little bit soft and debt's high. And then the fact that we've got $17 trillion of negative yielding bonds on the global scene, it does create a risk factor. At least this is through the Federal Reserve's eyes. And some of their biggest issues out there is that we've got, again, the small business issue, that we've got some of these businesses that are closing or scaling back. And then we've got a rising number of home mortgage holders that are behind on their payments. And then we know that real estate in many flavors, especially commercial, is being hurt by the vacancy issues and some of the non-payment issues out there. But on the flip side, they said the banks remain well capitalized, so we have structural integrity within our financial system. That's good, and that we've also got a very strong Federal Reserve response on this issue. So that's the view, I guess, really more of a near-term view of the Fed on the financial stability. So as we get into, like, maybe the closing assessments here, there are several takeaways, both on the plus and the negative side for stocks. And, then, we have these ongoing observations that I think are worth repeating here. So, again, we've got prospects for a divided government as we head into a presumed Biden administration. I think all signs are pretty clear on that now. So that means, I wouldn't expect a lot of change as far as large tax increases or spending initiatives, even though there's a lot of bipartisan support for infrastructure spending, and do expect that, and perhaps more tighter regulatory environment there. But as I said just a second ago, the timing and what the magnitude of a fiscal stimulus package, might look like, even though I feel like we're going to get one, it's all of that remains, the details remain very uncertain. And so that casts a uncertainty pall over the market a little bit. Um, and then we probably expect, some support, maybe, with a divided government, which, frankly, I think the prospects, for that, like I mentioned, are pretty strong. With that, I think that that's going to put a lid on what the package might look like. Maybe it's $1 trillion. Maybe it's slightly more than that. We'll just have to wait and see. I still think that until a vaccine is readily available, we've got a virus that's kind of, almost raging, to its own beat right now, and I think there's a risk that Europe itself goes into recession, which will obviously have implications for the U.S. And then, just in overall, I think we need to be concerned or have a care for the risks around the logistics of delivering a vaccine. And I think one thing that was missed in the Pfizer announcement is the fact that therapy that showed 90% efficacy in 94 patients, has to be stored at like negative 170 degrees Fahrenheit. So the logistics of transporting and storing that type of a vaccine in bulk are really challenging at this point. So and the virus could mutate, which is something that I've been reading about here over the last several days. So, which would render, some of the vaccine treatments out there, less effective perhaps than might be understood right now. But anyway, the progress that we've made on a vaccine is truly remarkable. And I think there's a lot of people that we should be very grateful for in the healthcare and the pharmaceutical industry. So I think, let's see, I talked about that. And so, yeah, and when we get, I think the real catalyst for us to recover our economic lost growth is going to be when that vaccine is readily available. And I think, there seems to be consensus that's coalescing around the fact that that might be the second quarter, perhaps the end of the second quarter next year. So that means that we've got, roughly a little bit more than a half year of, some of these controls, some of these modest restrictions on mobility and things like that. But at least there is light at the end of the tunnel. So with that, I guess the key takeaways as we kind of close here, positives for the equity market. We know the Federal Reserve is a backstop. They'll do what they can to support growth, even though they continue to clamor for fiscal support to dovetail with their monetary support. Even with this recent noise in consumer sentiment, with those numbers being off a little bit, we have seen unemployment drop below 7%. Right now, that's a positive. There's programs that are providing some benefits to workers that will terminate at the end of next month. And so, that is a risk factor. But right now, the consumer sector net is a tailwind for things. And I think the election wave, as I mentioned a second ago, having a split government, again, a split government from an equity standpoint doesn't tends to maybe be a little bit better for equities. The numbers don't bear out that it's a huge delta, but what it means is probably less of a near-term impact on economic performance because of higher taxes, et cetera. And obviously the news out of the pharmaceutical industry have been real positive for equities, and corporate earnings were really good too. So some of the things that I think we should not keep us up late at night, but we should be mindful for. The fiscal stimulus issue, uncertainties, it may be too small or maybe too late perhaps to stave off some additional wave of bankruptcy. Interest rates, we think, will continue to remain low, but they could go up. And we know that the Fed certainly wants inflation to go up. And if we get a whiff of inflation, you're going to see interest rates really rocket. And then, valuations, again, they're not out of line. They are above normal ranges. So, that's, it doesn't provide, let's just say the equities are not cheap. Um, and then, as I already mentioned, the vaccine logistics and things like that, you could have negative news flow, which could create some near-term shocks in the market. But I would just say that overall, I think you've seen the power in the markets. Um, the power of what positive news can do for you. I mean, the Pfizer announcement and the Moderna announcement early this, Monday morning, really show you the influence that kind of rhetoric can have on the market, even though there's no fundamental change in what's going on. But I think there's this growing consensus that 2021, especially the second half, is going to be really good, and the market loves to anticipate that. And I think we're seeing it priced in to some degree. I would argue that maybe some of the risk factors aren't being priced in as well, especially the impact of a European recession. But on balance, I think that the stage is set for a pretty reasonable 2021 that we can all look forward to. And I think the prognosis for stocks is decent. I think we can begin to plot a course that maybe for us at BKA, maybe it increases that international allocation as we get more clarity on whether Europe will actually go into recession or not. Certainly maintain what we have on the emerging market side. I think, continue to look at smaller caps that I think are going to already showing some life in the equity markets, but also show some life on their financial statements as well, and better performance there. But anyway, we will continue to watch these things and continue to report back to you as we see developments occur. So I think that will conclude today's comments today, and really enjoy having you with us. Thanks so much for listening today. Please feel free to reach out to us at the information provided on your screen. We'd love to hear from you. Have a safe week and have a wonderful week, and we'll talk to you soon.